Let's have a session on private limited companies. Now remember, private limited companies are a type of incorporated organisation or incorporated business. And a private limited company, or an LTD, is a company that is owned by its shareholders but is managed by its director. And shareholders will choose the director. Now the key features of a private limited company, number one is that shareholders are known to the company. And it is theoretically possible to have as little as one shareholder. And because shareholders choose the director, the shareholder, in that case, could choose themselves as the director. But in many cases, private limited companies will have 20, 30, 40, 50 shareholders, and they must decide who the director is. Number two is that shares are not sold on the stock exchange. That is something that a public limited company would have. And number three is that shareholders' losses are limited to their investment. So in the case that a company will become bankrupt, well, their personal wealth, their personal assets are protected by limited liability. But what they've invested into the company, when that may be sold off to pay off those debts, well, that is not protected. But what is protected is their personal assets and their personal wealth. Now, that leads into the first key advantage of a private limited company, which is limited liability. And limited liability is that shareholders' personal possessions are not at risk, as we discussed. Therefore, that might encourage them to invest in a private limited company compared to an unincorporated business. Number two is you have additional sources of finance here, because if you're a private limited company, you're able to raise finance through selling shares. So that's a type of equity finance. And also you would have the ability to raise debt finance through, for example, loans. So you've got debt and equity finance available to you. Number three is that you have control, because you're a private limited company, you have control over who the shareholders are. So therefore you have less risk of the fact that there could be conflict between owners and managers. And that's something that's more likely in the case of a public limited company, because in that case they do not have control over who the shareholders will become. So therefore they are faced with this problem being the divorce of ownership and control. And the final one is, well, sometimes it's seen that when you're comparing a sole trader to a private limited company, well, it's seen as having higher prestige, and that might generate more sales. Now, the cons of a private limited company. The first one is, because we said here shares are not sold on the stock exchange, they have no access to the stock exchange. So therefore, a smaller volume of finance is probably available. Remember, when you're a public limited company, there are enormous amounts of finance that you can generate. Number two is you're a private limited company, so you need to share your profits amongst your shareholders, and the more shareholders, that means the more diluted your profits may become. Number three is it's a legal requirement to publish your financial accounts. That's compared to if you're a sole trader or a partnership where you don't need to publish them. So your competitors may be able to see your financial accounts. Number four, because of number three, is there's more bureaucracy, there's more administration that needs to take place versus an unincorporated business such as a sole trader. You've got to do corporation tax, and you need to register your business, and the company accounts need to be done. You need to register it with a company's house, and also with those corporation taxes will have to be dealt with the inland revenue. So that's the pros and the cons of private limited companies. But if you get a question about private limited companies, it might be whether you should be a LTD, a private limited company, or a PLC, a public limited company. Now, when you're doing that, you need to think about that excellent mnemonic that is plums. Let's go through plums. So plums being how the profits are distributed, limited liability, unlimited liability, management and control, and sources of finance. With this one, we'll probably start at the bottom. So if you are deciding to be one of these two business structures, if you think about the S, sources of finance, well, the key thing is, do you want to have access to the stock exchange? Because if you're a public limited company, you will have access to the stock exchange. If you're a private limited company, you won't have access to the stock exchange. And it depends what you need and how much finance you need to how important that is, because you might need that finance to look to expand the business. Now, going back to the P being how the profits are distributed, well, it could be the question of, if you move from a private limited company to a public limited company, will the profits be higher if you're able to get that finance from the stock exchange and you're able to ultimately make more profits, and therefore the overall profits will be higher to you. So you need to make that consideration there. Now clearly if it's a private limited company to a public limited company, or the L and the U, so limited and unlimited liability, don't make much difference here because you're clearly in both cases going to have limited liability. Whether you're a private limited company or a public limited company, you have limited liability both times, so you retain it effectively. And the last one is the M, so the management and control, or the key thing there between a private limited company and a public limited company is this point here. So if you're a private limited company, you can control who the shareholders are. So you're less likely to have that problem of divorce and control. Versus in the case of a public limited company, perhaps, well, you might have that issue of divorce and control even more, and that could lead to problems. Now, one last consideration is if you are deciding between a private limited company and a sole trader, is that if you're a private limited company, you would be paying corporation tax. And if you're a sole trader, then you would be paying income tax. And it usually goes that the more profits that you're making, it would make sense from a tax perspective that you would want to pay corporation tax, because it would mean your overall tax bill would be smaller and therefore you retain more profits. But I hope that helps with private limited companies, and I'll see you at the next sesh.